Elon Musk, Jack Dorsey, and Cathie Wood usually agree with each other, but that's definitely not the case right now. The three CEOs have been debating about the most important economic issues. What is going to happen from the government's sudden creation of trillions of dollars? How can we protect our wealth going forward? Is an economic disaster on the brink of occurring? This video will go in depth on Jack Dorsey, Cathie Wood, and Elon Musk's debate on hyperinflation and the possibility of an upcoming market crash. Everybody knows that the Federal Reserve and Congress have printed substantial amounts of money, but nobody knows for sure what is going to follow. Jack Dorsey, the CEO of Twitter and Square, believes that he knows exactly what's coming, which is hyperinflation. Hyperinflation is when a currency's inflation rate passes over 50% per month, which is an annual price increase of 12,974%. An inflation rate that fast would obviously be a disastrous situation to be in. Prices would have to increase by roughly 130 times per year, which essentially marks the collapse of any currency. Whether it be Germany after World War I, Venezuela in the 2010s, or Zimbabwe in the 2000s, hyperinflation almost always equates to economic turmoil. Jack Dorsey recently stated that hyperinflation is going to change everything. It's happening. It will happen in the US soon, and so the world. One user replied to Jack by stating that hyperinflation is the worst outcome for most currencies. Jack Dorsey further elaborated by saying, "Not a wish, nor do I think it's positive at all. Consumer prices are currently rising at an annual rate of roughly 5%, which is nothing compared to the scenario of hyperinflation, which requires an annual increase of 13,000%. So why does Jack Dorsey think hyperinflation will occur? One of the well-known indicators is the amount of M2 money, which has increased to enormous heights. M2 money is a tracker of the money supply that includes cash, checkable deposits, and other forms of easily convertible money. Total M2 money has increased from $15.4 billion in February of 2020 to $20.9 billion in September of 2021. That is a 35% increase in the money supply in 19 months, which is certainly unprecedented. This dramatic increase in the money supply may initiate an inflationary cycle. When consumer prices rise, employees will demand higher wages to pay for increasing prices. As a result of that, consumer prices would rise even more from increased consumer demand, leading to higher wages again. Because wages increased, consumer prices would increase again. This economic relationship is called the circular flow model, because an increase or decrease in one segment always impacts the other. If the inflationary cycle goes out of control, then hyperinflation may occur. Jack Dorsey knows that such an event would be disastrous and has been allocating a significant portion of his wealth to Bitcoin. This is evident from his Twitter bio, which literally just says Bitcoin. Dorsey is also protecting Square's balance sheet from hyperinflation by allocating a portion of Square's cash reserve to Bitcoin. While Dorsey's prediction may sound relatively logical, there is one investor that totally disagrees, which is none other than Cathie Wood. Cathie Wood ranted on Twitter in response to Dorsey. She explained exactly why Dorsey is wrong about his assumptions. Cathie first started by examining a common mistake that investors make. She made that mistake herself as well. Cathie explained how in 08 to 09, when the Fed started quantitative easing, I thought that inflation would take off. I was wrong. Instead, velocity, the rate at which money turns over per year, declined, taking away its inflationary sting. Velocity is falling. Cathie is essentially saying that an increase in the money supply does not necessarily lead to more inflation. This is because in order for prices to rise, consumers have to spend money. If consumers store all of their money, then an increase in the money supply would not lead to inflation. The decreasing velocity of M2 money shows that consumers are not spending the money that they recently received. The velocity of money tracks how much money is spent on goods and services within a period of time. Despite the massive increase in money printing, the velocity of M2 money has actually been decreasing rather than increasing. This means that consumer demand is not increasing, so any inflation in the US dollar was likely spearheaded by supply shocks. And just like every imbalance in the capitalistic system, what comes up must come down. Cathie believes that as supply chains ramp up, inflation will begin to cool down. She explained on Twitter by saying, "Now we believe that three sources of deflation will overcome the supply chain induced inflation that is wreaking havoc on the global economy. Two sources are secular or long-term, and one is cyclical. Technologically enabled innovation is deflationary and the most potent source. Technological cost declines and the destruction of old technologies will create substantial deflation over the long term, but there is one factor in Cathie's list that will occur on a specific time frame, and that is the holiday season. Cathie believes that following the holiday season, there will be a sudden realization that businesses have overstocked on inventory. Cathie explains the third and most controversial source of deflation is cyclical. Because businesses shut down and were caught flat-footed as goods consumption took off during the coronavirus crisis, they still are scrambling to catch up, probably double and triple ordering beyond their needs. Businesses are panicking to meet the consumer demand for goods, which has led commodity prices to increase to all-time highs. The global price index of all commodities is up by roughly 57% in the past 12 months. That is a significant increase in a short period of time, but the bubble is about to crash soon. Businesses have ordered too much inventory, which will become apparent as Christmas comes by.
We believe that businesses might be thinking falsely that they need to keep scrambling to catch up with consumer demand because they can't keep up with it and the shelves are bare and they're losing sales. Well, what if the inventory pileup in the household takes consumption down during the all-important holiday month, especially late November and the first 3-4 weeks in December? Then they do have excess inventories if they've scrambled and the consumer does not come.
Cathie believes that once the holiday season passes and companies face excess supplies, prices should unwind. Some commodity prices, lumber and iron ore, already have dropped 50%, and China's crackdowns are one of the reasons. The oil price is an outlier and psychologically important. Elon Musk replied to Cathie's argument by saying, "I don't know about long term, but short term we are seeing strong inflationary pressure." Elon knows that he is not an economist, so he stuck to the facts rather than attempting to take a stance on the economy. Everyone knows that inflation has taken place in the short term, and nobody, including Elon, knows what will happen over the long term. Cathie Wood and Jack Dorsey have completely different opinions about the future, whereas Elon seems to be accepting the facts that he knows nothing about inflation. Elon's opinion is a stance that makes a lot of sense in our current situation. Nobody decisively knows what will happen, and investors can try to guess what will happen. However, as investors, we should always hedge our portfolio for every scenario, no matter what macroeconomic outlook you have. I believe that inflation will start to decelerate within the next 12 months, but I still own some shares in inflation-protected companies. With that being said, let me know who you agree with down below. Is Jack Dorsey, Cathie Wood, or Elon Musk right about our current situation? If you enjoyed this video, please hit the like button and subscribe, and I'll see you in the next one.